The next move of the Fed on rate cuts is in the spotlight. While inflation has been stickier than expected, we still expect the Fed to cut rates in the third quarter, while the Bank of England and the ECB should probably cut rates earlier than the Fed. So we take the opportunity to lock in current attractive bond yields. For equities, thanks to global cyclical tailwinds, we are broadening our geographical and sector exposure as we see many opportunities for investors to put their money in. Here are our 4 investment themes for the coming quarter. What we see is a more positive economic and earnings outlook, which supports our bullish view on equities. And although the US is still the driving force behind global growth and remains our biggest overweight position for equities, the economic cycle in Europe, the UK, and Japan seem to have bottomed out, and momentum is picking up. Asia remains a key growth engine, with India enjoying strong growth momentum and investment flows, whilst South Korea benefits from rising demand for AI and memory chips. So we think investors can look beyond the US equity exposure and diversify into these other geographies as well. The cyclical and structural growth drivers are supportive of a range of sectors, meaning that although IT remains very exciting, it's not the only option. In the US, easing interest rate cost pressures, a healthy labor market, as well as secular trends such as AI innovation, nearshoring of jobs, and US industrialization bode well for IT, communications, consumer discretionary, financials, industrials, and healthcare. But while we have a clear cyclical sector tilt in the US, our sector exposure mix is more balanced in Europe and Asia, where higher spending from corporates and households is powering IT and consumer discretionary. We also like European financials on low valuations and increased M&A activity, whilst energy and healthcare, which are more defensive in nature, also offer compelling opportunities. And in Asia, low valuations have recently been driving more interest in communication stocks. Robust industrial production in India and China supports our recent upgrade of industrials to overweight. Consumer staples and utilities are preferred non-cyclical sectors. The dividend payouts from some Asian utilities companies look attractive as interest rates fall. With bond yields at multi-year highs and rate cuts approaching, it's a good time to put cash into bonds and lock in current yields for income generation. Once rates are cut, bond yields will fall, which should cause prices to rise, further boosting total returns. Meanwhile, interest on excessive cash holdings will become less attractive. And as high-quality bonds provide attractive risk-adjusted returns, we continue to like US Treasuries and UK gilts with medium to long maturities, as well as investment-grade bonds with medium duration and Indian local currency bonds. Even if investors are keen to preserve liquidity, short-dated bonds are preferable to cash. Finally, clean energy and biodiversity remain priorities for governments and corporates in terms of investment, government policies, and global governance. Last year was a record year for investment in the energy transition. In addition, global initiatives on biodiversity are likely to play out across multiple industries such as food, pharmaceuticals, and cosmetics. So in conclusion, we think the combination of global equity exposure and quality income from bonds is a good way to capture the broad set of opportunities. However, market volatility arising from mixed economic data, ongoing geopolitical conflicts, and the upcoming US election should, of course, not be overlooked. But a diversified portfolio or a multi-asset strategy may help you weather market volatility. As always, we are here to help you incorporate these themes in your portfolio.